My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. Merry Christmas, everybody. It's December 25th. I can't believe it. It's the last Sunday of 2022. This year has been a roller coaster of a year. There's been a lot of ups and downs, not only in my professional life, but also in our personal lives. It's been a really interesting experience. My wife and I, we live down here in Austin, Texas. We're fairly new parents. We have a little baby boy. It's kind of weird. Like every time I talk about him, he's just getting older and older. And I want to say he's a little baby, but in reality, he's more like a toddler now. He's almost, a little over a year and a half old. He's actually sick today. He was sick yesterday. And so, if you're a parent and you've got like a sick baby, all they tend to do is like scream and cry and not sleep. And what does that do? It's like you got a little person screaming at you all day. It kind of like makes your head kind of spin and have a headache. For those of you that know, you know. And so I got a little bit of a headache because my little boy has been screaming all morning. But I'm gonna muscle through. I wanted to make sure that I made a video here today. This is the last Sunday of the year. When I look back on 2022, I've made a video every single Sunday, and I don't want today to be the exception. So with that, we'll jump right into the video. So in today's Review My Pie, we're going to answer one subscriber question, then we're going to review three portfolios. The first is going to be from an 18-year-old here in the US, the second, a 22-year-old from Romania, and then the third, a 62-year-old from the United States. As always, everybody, the timestamps will be in the description, as well as the portfolio links will be in the description below. And as always, everybody, I'm not a financial advisor. Don't take what I'm saying as professional financial advice. It's just merely for your entertainment. And once again, if you're new to this series, I don't review the portfolios in advance. I review them as I'm recording the video. I'm trying to keep it as genuine as I possibly can to make it, as authentic as I can. So it's not scripted or anything like that. But first, before we dive into the video, I just want to say thank you so much to everybody that supported the channel. This week, we hit over 50,000 subscribers. I never thought growing up that I was going to be a quote unquote influencer or content creator, but I can now officially say, hey, Ma, I'm a YouTuber. Whatever that means. But yeah, for those of you that have been, following the channel for a while, thank you so much. If you're new or you've been here for years, I just genuinely thank you so much. I never thought that, that people would actually listen and watch my videos. When I first created the channel, it was just more of like an experiment just to have fun. And I've tried to keep that in every single video. I don't like to take myself very seriously. I don't do magic. I'm just a normal dude who has really poor editing skills. And I tend to stutter my words here and there. But if you're a longtime subscriber to the channel, thank you so much for sticking with me. I'm so excited to continue making YouTube videos here in 2023. I'm not the type of person that's gonna go and post an Instagram picture of me with balloons, saying, thank you everybody, 50K subscribers. Because if I did, it would probably look a little like this.
100. Babe, do you know what this means?
What?
I'm so important. Woke up with 100K. I just wanted to say thank you so much for following me, and I love you guys.
Last but not least, I want to thank me. I want to thank me for believing in me. I want to thank me for doing all this hard work. I want to thank me for having no days off. I want to thank me for never quitting.
Oh my gosh. Oh man. All right, cool. So let's take a look at the first question here. This is from Nicholas. He writes, hi Jake, I wanted your advice on whether I should switch over from investing into VYM, SHD, DGRO, and SPYG. These are all, different ETFs, high dividend and dividend growth ETFs, to just SCHD and DGRO, or just to keep what I already have. So really quick before I read the rest, Nicholas is referring to a video that I made here recently, The Simple Path to Wealth. In that video, I talk about just investing into SCHD and DGRO, and I go into detail around, kind of why that is. So, and then he continues writing here, I used the portfolio visualizer to compare both, and they ended up being very similar. The reason for asking this is because I want to be able to keep things simple and basically hold these ETFs for the rest of my life without having to sell them. I currently like the idea of just investing into SHD and DGRO, but I'm wondering if for the next 15 to 20 years, would I be able to just still live off these two ETFs? Or would I have to diversify a bit more and invest into something else later on? I'm currently 21 years old and I'm currently going to school with a part-time job. I will also be holding this in a taxable account on M1 Finance. Thanks in advance, Nicholas. Okay, so this is a really good question, and I want to start off by saying that everyone's situation is going to be different, but I'm going to share with you really briefly, if you want more details, why I'm suggesting SHD and DGRO, I would recommend go watch that other video. I'll leave a link in the top right. It'll add a lot more context. But essentially, the reason why I made that video was for those of you out there that want it simple. They want it straightforward, the easiest way that you can be a dividend investor, live off of your dividend portfolio, your dividend investments, the simplest way possible. SCHD and DGRO are a great combination and you can accomplish that. When looking at the next 15 to 20 years, you could absolutely go all in on SCHD and DGRO, and in my opinion, that would be fine. If you wanted to keep VYM, SCHD, DGRO, and SPYG, that would also be fine. And let me give you kind of some pros and cons to both. The pro with your approach with having all of those is you're going to have maybe a little bit more flexibility. Let's say in 20 years, you have a big life event. You buy a house, you need to buy a car, or you have a large expense. You can take the growth and, assuming that the market is up and, there's a lot of different variables, but let's say you could take SPYG at that point, which is growing the fastest of all of these, you could then potentially have more flexibility and you could look to sell SPYG and then you could either buy a house, you could buy more SCHD, more VYM, you have flexibility. So that's one of the advantages of yours, because you have a little bit more flexibility, okay? But then again, it's a little bit more hands-on because you kind of have to plan with that. Versus SCHD and DGRO, the advantage of those two is it truly is you set it up, automate it, and you forget about it. In 20 years, after reinvesting the dividend for 20 years, after auto-investing every week, every month, it's really just one of those that it's kind of that snowball. Slowly, gradually, it's going to increase every single month, every single year. The dividend income is going to continually grow. But because those are the only two investments that you have a little bit less flexibility. Now, there's no right or wrong. It really depends on you and your personal situation. But I really like both options. And it really comes down to what's the right approach for you. And that's where getting quote unquote investment advice or someone's opinion on the internet can be a little bit dangerous and maybe counterintuitive, because everyone has a different opinion because they're in a different situation. You can ask 10 other people, they can give you 10 completely different responses or answers. Okay. What you want to do when you're 21 years old and you're thinking about your financial future, you want to think, what's the right approach for you? Get information, get ideas from others, but use those ideas to help you make the decision that's right for you. Okay. And then don't feel bad or feel confused if somebody is telling you something different, because they could be in a completely different, situation. They could have a different risk tolerance. They could have different expenses, that's what makes this so challenging when you're going and you're reading, blogs and comments about, how to invest, how to do this. They call it personal finance for a reason, because it's personal. Okay. But I stand by what I said. If you want the simple path to wealth with dividend investing and you never want to sell your shares and you want it very, very simple, SCHD and DGRO are the way to go, in my opinion. If you also want to have a side investment, for kind of like a rainy day, a house fund, then you could add something separate. But the simple path to wealth with dividend investing, if you're looking to retire early here in the United States and you're not looking to invest in a tax sheltered account, you want to retire before the age of 59 and a half, SEHD and DGRO are the way to go, in my opinion. So I hope that helps. Once again, if you have any questions regarding those two investments, check out my other video. I go into much more detail around the why. All right, the first portfolio is from Collin. He writes, "Hey Jake, my name is Collin. I'm 18 years old, turning 19 in a few weeks. I live in the US and would like to retire around 50. I have a Roth IRA as well as a regular taxable portfolio. I plan to dollar cost average into these portfolios every couple of weeks. I believe my portfolio is good, but I know they're not perfect. I would love to hear I'd love to hear anything you have to say about them." Okay, so Collin, this is really good. So you're 18 years old. You have a time horizon of around 50. Now, this is a long time, right? So let's pull out my little calculator here and let's take a look at this. So 50 minus, let's say you're 19, that's 31 years, right? You roughly have 30 years before you plan to retire. Now, I want to be very transparent, very honest with you, Collin. Man, when I was 18 years old, I had no idea what I was going to do with my life. I had no idea. I think at that time I was probably playing like World of Warcraft or something, and that's all I really cared about was leveling my mage, right? Like that was me when I was 18. Fast forward now when I'm 36, man, my priorities are entirely different than they were when I was 18. My expenses are different. I have a kid that screams all day, right? And runs around. He's cute as heck, but he screams a lot. I have no idea where I'm going to necessarily be in 20 years. So the reason why I'm saying this is understand that your plans are probably going to change. And so at this point, you want to focus on understanding your goal, setting yourself up for that goal, but realizing that the reality is you're probably going to change your mind 5 or 6 times before you reach that goal. Okay? Because life happens. But regardless of that, I'm going to, let's assume that this plays out exactly how you plan it. I'm going to talk about how you can construct your portfolio based off of this goal. But I do want to preface, your goal is probably going to change about 6 or 7 times. All right, let's first take a look at your taxable account. So your taxable account, we can't really see the whole historical performance. We can see that you have a low expense ratio, which is very, very good. You have a dividend yield under 2%. This is good. This is comparable to the S&P 500. Okay, so this is something that you want to be aware of. You have 36 holdings and you're getting, kind of comparable results to the S&P 500. All right. So I want you to keep that in mind when you're thinking about this. You're setting up your portfolio like this, and you're getting pretty comparable to the S&P 500. You may question yourself whether or not you want to focus more on ETFs. But let's take a look at this. You got technology, ETFs, consumer, semiconductor. You even got some energy in here. Okay. Let's take a look at your technology. Technology, you got Meta. Meta at 25%. Google at 25. Okay. Let's pull up my calculator here. You got 0.18 times 0.25. You got 4.5% into these. For those of you that follow the channel, you know what I'm talking about here. No, I don't want any holding. I don't want to see any holding over 5%, one single company. It's just too risky. When it comes to these companies, I think it's just the important thing to understand that these have been really, really great companies of the last 10 years. Are these going to be really, really great companies of the next 10 years, 20 years, 30 years? No one really knows. The good thing here is you don't have any of these holdings over 5%, so that's what I do like. Let's take a look at your ETFs here. You got VGT, VTI, SPYG, SCHD. I like this actually a lot. I like this a lot. Okay, so I'll make a suggestion here in a second. So yeah, I like all of these ETFs. I think this is good. Consumer, what do you got in here? Costco, Amazon, Target, Home Depot, Coca-Cola. Okay, I like that you have Coca-Cola lower. Okay, I think this is fine. What I'm also looking at is your average dividend yield. I don't want to see the dividend yield ideally over 2%. So this is good so far. What is this at? This is perfect. Semiconductor. See, it's over 2. I don't want to see that. Intel and Texas Instruments. I do like NVIDIA. I would see This is a bit high. The reason why is this isn't a taxable account. You're going to be paying taxes on this for the next 30 years. Probably not something that you ideally want to do. This one I would probably lower a little bit. Let's see, healthcare, AbbVie, United Healthcare, Johnson & Johnson. Yeah, this is fine. Once again, it's over 2%. Yeah, financials, JP Morgan, MasterCard, PayPal, T. Rowe, Visa. The thing that I'm noticing about your portfolio that I like, you have household brands, you have, blue chip companies. Everybody knows these companies that are in your portfolio, which I really like. UPS, Caterpillar Waste Management, Lockheed Martin. These are well-established brands. I don't think that they're really going to go anywhere. I think that's fine. Materials, MP Materials, okay. Applied Materials, okay, cool. 2.5. Communications, Verizon. I don't like Verizon. Comcast. No, I don't like Verizon. It's not growing nearly as fast as Comcast and others. Personally, so here's what I would think about this is there's no real, Verizon is not compounding and growing as fast as the others. So the question is why do you have it in here now? So this is what I want you to think about, okay? Over the next 30 years, your priorities are going to change and things are going to change. You're going to make more money later on. What I would recommend is look and see, invest into companies now that are growing very quickly. Okay, Verizon is not one of those. And then once you get maybe 5 years before you plan on retiring, then look to add yield. Verizon is a yield play. This is like a bond. It's a qualified bond, right? But it's not growing nearly as quickly as, for example, your Google or your Microsoft. So what I would recommend is anyone that has a long-term time horizon, you don't have to build your portfolio if you have a 20-year time horizon, you don't have to have it set up today as if you were retiring tomorrow. You don't have to have everything in there today that you would ultimately want once you retire. Okay, so what you could consider doing, as I just mentioned, look to add these high yielders if you want them later on, once you get closer to retirement. A couple of things. One, your compound rate, the dividend plus the capital appreciation will be higher. Two, you'll have less of a tax burden over the next 30 years. Do you understand? Okay, great. I'm glad. All right, we're on the same page. So, energy, you got, these are utilities. So utilities. Next are energy, Southern, Duke. Yeah, I think this is fine. I like that it's at 3%, right? These are all fairly equally weighted. If you look at these like 0.30 times 0.03, you got like 1% allocated to these companies. I think that is fine. Okay, Collin. So here's what I would recommend you take a look at. Okay, so first off, I like that your dividend yield is under 2%. If I was you, I would try to get this dividend yield to right around 1.5%. See if you could get it at around 1.5%. How you can do that, for example, this is what I would recommend you do. I would look at focusing now for the next 10, 20 years, focus on growth, and then in 20 years, assuming that your goals have not changed, which they probably will, then you can look at adding high yielders to your portfolio. Okay, so in the meantime, what I would recommend is skew heavier towards growth. What I personally like is I like this. This is my favorite slice that you have in here. And look at this, it's right at that 1.5%, right? So in my opinion, this is probably not what you were expecting. In my opinion, I would put this slice at least 50%. I would put this slice at 50% and I would lower the rest. And then as you get closer to retirement, as you educate yourself more on investing, as you get more aware of where your financial priorities are, then you can look to adjust. Okay? So that's how I personally view this. And this is not just for you, Collin. This is for everyone, especially if you're new to investing. I would heavily skew more towards ETFs than individual companies. Okay. If you want to have individual stocks, that's fine. But your core should be your ETFs. Okay. And that's why I'm recommending that. All right, let's take a look at your Roth IRA. Your Roth IRA is up. You can see the historical performance since 2017, decent expense ratio, decent dividend yield. What do you got in here? VTI, VGT, VIG, and SCHD. I think this is absolutely fine. I like this. There's a couple of reasons why I like this. So first off, I have my portfolio set up in a similar way. Okay. I invest 100% into ETFs in my Roth IRA. I want to set my Roth IRA up and forget it. I don't actively manage it. I don't trade in it. I set it, I fund it on a regular basis, and I forget about it. Okay. That's how I manage my Roth IRA. I manage it by not managing it. I automate it. So I like VTI as the largest holding. I like VGT as the second, equally the largest holding. VIG and SCHD. So here's my thoughts. Okay. Now you can do with this what you want, but I would consider either adding or replacing one of these with an international ETF. I don't know what the future is going to hold, but I personally think about a 10% to 15% allocation to international would be wise. So what I would recommend is potentially looking at VIG, either lowering it, or if you want, you could even replace it, in my opinion, and get an international ETF. My personal favorite, if you just want core international exposure, not US, VXUS. I own that in my Roth IRA, for example. So in terms of how you have your setup, so my Roth IRA, I have VTI, VGT, VXUS, and I have VNQ. Those are the ETFs that I have in my Roth IRA. But if you wanted to keep this is fine. But that's one thing that I would potentially consider is maybe some international exposure, something that you can look at there. All right, let's take a look at the next one here is from Andrei. He writes, "Hello, Jake. My name is Andrei. I am 22 years old. I live in Romania, and I am in my final year of computer science. I started my dividend investing journey in the spring of 2020. Currently, I invest on average €275 a month into my portfolio, which is taxable. I hope I can get this to 500 plus a month once I graduate and start working full time. My plan for the future is to retire by 40 years old and live off of dividends. I am using Trading 212 to invest in dividend stocks, and I grouped up my stocks into 8 different categories using the pies available on Trading 212. I'd like to know if I made a good choice with the stocks I currently own, and if not, which ones are too risky and not worth holding on to." So first off, man, this is so great. I'm so excited for you. Somebody in Romania is watching the channel and learning about dividend investing. All right, well, there's a couple of things that come to mind. I think this is so great. The big advantage that you have outside of the United States is, in many cases, the healthcare. Now, here in the US, the healthcare costs are going to be some of our largest expenses in early retirement. I'd be curious to hear what your healthcare expenses would be in Romania. I know, having lived in Germany, we would only pay out of pocket, for our maximum out of pocket, like $450 for our whole family if we were to retire in Germany. It's just such a huge advantage that you have over there outside of the United States. That's something that I think a lot of people, if in Europe, if you were to really do the numbers, you have such an advantage over us in the United States because of the healthcare costs. So kudos to you, man. I think this is great. All right, so it looks like you have about an 18-year time horizon. Let's take a look at your portfolio and let's see what you got here. So you got, in this first section here, you got Procter & Gamble, Lowe's, PepsiCo, Home Depot, Coca-Cola, Philip Morris, and Starbucks. I mean, there's really not much I can say about these, negative that I can say about these. These are all really, really great established companies. You have a combination of dividend growth. You have a combination of, dividend growth, high yield, You got Procter & Gamble and, in a Dividend King here. These are really, really good brands. I mean, some of these I own in my own portfolio. I own Procter & Gamble, Lowe's, Pepsi, Coca-Cola, and Philip Morris. So, I mean, I own a lot of these as well. What else you got in here? You got Johnson & Johnson, Merck, Medtronic, Bristol-Myers, AbbVie, Pfizer. Yeah, I mean, Medtronic has really been taking a beating. I still really, really like Medtronic. I think it's still a really great company. You have a good, like I said, you have a good balance of growth and yield. You got 3M, these are your industrials. You got 3M, Caterpillar, Union Pacific, Lockheed Martin. What do you got in here? You got real estate, you got Realty Income, American Tower, McDonald's. They kind of are a real estate company, actually. And Digital Realty Trust. Yeah, I think I like, Andrei, I like all of these companies. Every single one of these companies. What do you got for financials? JP Morgan, BlackRock, Aflac, T. Rowe, Toronto, TD. Okay. What do you got in technology? Microsoft, Apple, Intel, Cisco. What do you got in here? You got utilities, Duke. It's like PBM or PBA, one of those. Yep. Air Products and Chemicals, Chevron, Nexter Energy. Okay. What do you got in telecom? Walt Disney, Verizon, Comcast, AT&T. Telecom is just getting destroyed this year. Okay. All right. So every single one of these companies I've heard of. They're well-established companies. I guess what I would ask you is, do you have access to invest into ETFs? Could you invest into an ETF like SCHD or DGRO? I think that's the one piece that you may be potentially missing, is getting exposure to, a market cap weighted ETF like SCHD. If you're not able to get, SCHD in Romania, I think these companies are good. The one thing that I would just recommend is when you're looking at your whole portfolio, make sure that not a single company is over 5%. And if that's the case, I think you're fine. And then the last thing that I'll say is when you're looking at it from just an individual company perspective, go and look at your portfolio weighted average of what is the current dividend yield and what is the dividend growth rate. And then what you want to do is you want to kind of structure your portfolio so that you're still getting growth over the next 18 years and the dividend is it's growing at the right rate. And if you're not sure what I mean by that, go on my channel and watch the videos that I've made on how to invest based off of your time horizon, because this video is ideal for someone like you. When you're constructing your portfolio, it's important to understand the CAGR, the dividend growth rate, and how that can help you help you invest based off of what your time horizon is. So I hope that helps. Thank you so much for sending over your portfolio. All right, the last portfolio here is from John. He writes, "Hello, Jake. Really enjoy your YouTube videos. I'm one of your older subscribers since you started your channel, living just southeast of Austin near you in the home of Bluebell Ice Cream Country, Brenham, Texas." John, shout out. Shout out to you, man. I'm 62 years old, married to my Filipino wife. We married 24 years ago in the Philippines and have one son. Oh man, that's awesome. I'm still working in Houston and want to continue working another 5 to 6 years. I still contribute to a 401k with the current company I am with. We were taken over by another company 1 year ago this past September. I still keep maxing out my IRA each year and try to max out my HSA each year. The HSA is also invested with an advisor with health equity, mostly Vanguard mutual funds, okay? And put as much as I can into the 401k. Also have broker's account with Schwab, purchasing only a small amount of SHD every month. Man, John, this is amazing. You got your 401k, you got your IRA, and you got your HSA. When I read 62, that was going to be the first thing that I was going to suggest. So this is great to see. Currently, my traditional IRA, approximately $210K in a wealth building aggressive. Okay, so this is your allocation here. You have your Schwab Intelligent Portfolios through a robo-advisor from May 18th to November 5th this year. I'm only down 6%. Current dividend yield with this portfolio is 2.25, 8% in cash, 6% in bonds, 86% in stocks, all ETFs, Schwab, and Vanguard. Sorry to drag this email out, but I wanted to ask your opinion. I have been following your ETF portfolios based on years to retirement. So this is the how to invest based on your time horizon. I want to transition over all of my investments over to the dividend income portfolio. Schwab also has a dividend income focused portfolio, which I can transition to from the wealth building portfolio. Schwab selects the investments in both of these portfolios based on the investor's risk tolerance. In your opinion, should I wait a few more years to transition and invest in my own dividend income with a little growth portfolio? I think the market will skyrocket in the next 2 to 3 years, maybe sooner. You continue writing here. So this is the first question. I'll make sure I get back to that. I want to do it with all ETFs. I was looking at the following ETF portfolios. SEHD 30%. Okay, so let me answer this here really quick. So you're talking about, should I transition this portfolio over? The couple of things that I would, bear in mind is first the taxes, right? Understanding how, if it's in a taxable account, if you're selling versus, doing account transfer. The one thing that I would focus on is how to optimize for taxes. Right now, that's what would be top of mind, in my opinion, is to factor in what is going to be the most tax efficient either now or over several years. Okay, so that's how I would respond to that question is I would do it based off of tax optimization. So when looking at the portfolios, you got one SEHD, VYM, SPYD, okay, because it reads DGRO, QLD, and RYLD. Second, SAHD, VYM, SPYD, JEPI, DGRO, JEPI, JEPQ. Okay, so you have some different. Okay. All right, so these are the different ways that you could go about doing it. All right, then lastly here you write, finally, we're almost finished paying our beautiful home off in Brenham, which has a very good value even in these downturns. We plan on downsizing and invest the money from the sale of our home. My wife and I plan to retire in Southeast Asia, most likely the Philippines. Use that as a base to explore and slow travel to Bali, Penang, Koh Samui, Vietnam, Singapore. We can live very inexpensively, especially in the Philippines. If we can generate at least another $2,000 per month more, that would be great. My wife is also a U.S. citizen and will be collecting Social Security when the time comes. Thanks and regards, John. Well, John, this is really, really incredible. Okay, so a couple of things. First off, I am not an expert when it comes to Social Security, when it comes to Medicare, when it comes to all of those different programs that you get access to once you reach the age of 65, for example. So a couple of things that I would throw out there that I would make sure that you are aware of is what are the implications of kind of this geo arbitrage living outside of the US, how that's going to be, how you're going to be impacted when it comes to like Medicaid, Medicare, all of those different things that come into play. Because the reason why I'm saying that is I was looking at retiring early in Panama, and there was a video that I was watching, and they said you have to keep a residency in the U.S., otherwise you forfeit your health care. And so I found that really, really interesting. And so I would just make sure that you were aware of all of these things when you're thinking about living outside of the US, selling your home, because there's a few complications that come with that. So you're at that age where you really want to make sure that you get that right. And I want to preface that I am not an expert when it comes to that. I need to do my own research. But when it comes to the passive income from dividend investing, that's where I can help you. That's where I'm pretty good, I think. So a couple of things that you want to think about when you're 62 years old. First off is the type of accounts that you hold the money in. That's the first thing. So you want to make sure that you're taking advantage of these tax advantage accounts like it sounds like you are. You may even want to consider, you mentioned a traditional IRA. Once you leave the US and you're in a lower tax bracket, what you may want to consider is, incrementally each year, transitioning that over to a Roth IRA. Because you'll be in a lower tax bracket, it may be advantageous for you to slowly transition that into a Roth IRA. Something to consider. When it comes to your investments, I think, I like the only ETF approach. I think that's really, really good. I like SCHD, I like VYM. I think those are probably your safest bet when it comes to getting, dividend income. I would say there's a lot of interesting ideas out there on the internet. I think SCHD and VYM are probably your most conservative way of generating dividend income. The reason why I like it is you're getting the best of both worlds. You're getting a higher dividend than the index, the S&P 500, and you're getting dividend growth. So each year you're going to get a pay raise, assuming everything stays constant, but nobody has a crystal ball, right? So I like that. What I like is, you're also considering other options for higher income. So the way that I would look at this holistically, if you have your total portfolio of 100%, carving out, 75, 80% or 70% into SCHD and VYM, I actually really like that. And then keeping a small portion in cash or in bonds, I think is a really good idea. Having really liquid cash is never a bad idea. And then if you wanted to add a little bit more speculation to generate a higher yield, I really like JEPI and I really like JEPQ. I really like these. Now, 10% in each of these might be a little bit high. You may want to consider 5%. 5% in JEPQ, 5% in JEPE would be maybe something you could consider if you really, really want to spread out your risk. But that's just kind of my thoughts, right? That's how I look at that. But I've just shared kind of a lot of information. Let me summarize what I just said. First off, make sure that you understand your taxable accounts. You got your HSA, your 401k, your traditional IRA. See what you can do over the next couple years to maybe transition those into a Roth IRA to really get the best tax treatment possible. Then focusing on your core, have a core of 70 or 80%. And I really like SCHD, I really like VYM. There you're going to get the most conservative dividend growth income out there, in my opinion. And then having that remaining 20 or 30% be a combination of cash, bonds, and potentially, these cover call ETFs and JEPI and JEPQ. In my opinion, probably the most conservative way of going about this, if you're focused on looking at dividend income, trying to live off of a dividend portfolio. The reason why I like this as well is you're 62 years old, you're probably going to live another 20 plus years, right? And so you want to make sure that you're getting an increase in your dividend income each year because inflation is a thing. But yeah, I think this is really, really incredible. I love the idea of, traveling, going back to the Philippines. I think this is going to be really exciting for you. Keeping it simple, keep it straightforward. And the last thing here is make sure that your wife is educated on your plan. Make sure that your wife understands how the investments work. If the unthinkable were to happen to you, that your wife is taken care of and she knows where the investments are, how they're invested, what the strategy is. Make sure that you're involving your wife in this process so that she's educated as well. But yeah, thank you so much, John. It was great to see that you're, another fellow Texan here on the channel. I hope that this was helpful. Thank you so much for watching, everybody. I hope that the video was helpful. I hope that you learned something new. Before I forget, just want to give a quick shout out to Seeking Alpha. They support the channel. I absolutely love working with them. They're running a flash sale until the end of the year. If you want to sign up to Seeking Alpha Premium, you can get it for $39 instead of $239. So it's actually 83% off. This sale will be going on until I think the 2nd or 3rd of January. So if you're interested in that, and you want to support the channel, you can use the link in the description below. Thank you so much. Thanks everybody for watching. Merry Christmas. I'll catch everybody in next week's video.
Please subscribe. Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.